Most business owners spend 20 or 30 years building a great company, and then the day they sell it, they leave 30, 50, sometimes $100 million on the table. Not because the buyer took advantage of them and didn't give them the right price, it's because nobody ever taught them how the process actually works. I've spent the last 10 years on Wall Street selling companies. I've closed over $20 billion worth of transactions before I turned 30. I've advised Fortune 500 boards, private equity firms, and hedge funds, and was at one of the largest investment banks in the world. The advice I'm about to share with you is the same advice I gave companies worth billions of dollars, $1 billion and up. The kind of advice the average business owner never gets access to because, quite frankly, Wall Street does not take their call. So in the next 10, maybe 15 minutes, I'm going to give you the most important things I learned closing $20 billion of exits. The questions you have to answer 12 months before you sell, the team you need to assemble when you do the transaction, and the deal structures that can turn a $100 million headline number into a $50 million payout. The numbers the buyers are going to use to actually value your company, the mistakes you're going to make that are kill deals, and ultimately the moves you can make that actually double the value of your company. So if you ever plan to sell your business, even if that's a year, 3 years, 5 years out from here, you're going to want to know this right now because almost every move that you make matters before the buyer is actually in the room looking at acquiring your business. The first question I'll ask any business owner thinking about selling before we even look at the financials is why? Because the answer to that one question changes the entire deal you should be running and the structure of that transaction. For example, if you want to retire and never think about this business again, then you want a very clean exit. You want maximum cash at close, minimum contingencies on the back end, and you may not even care about a non-compete because you're no longer going to be in this industry. You don't care. If you want to bring in a partner who's going to grow the business while you stay on as a minority owner, that's a very different transaction altogether. Now, if you're looking to chase something else, like a totally new industry or a new opportunity, you're an opportunistic seller and you want to make sure the transaction does not restrict you from being able to do that. And if you're just quite frankly exhausted, you just don't want to run this company anymore, you're a fast exit seller. You're optimizing for speed, not for the absolute top of the price range. And it's very important that you have to know which one you are before you take a single meeting because the banker, the lawyer, the buyer, all of them are going to read your goal based off of your behavior and they're going to structure the deal accordingly. And if you don't pick which goal you want, somebody else will pick it for you based on the deal dynamics. Now, the second question, once you know why you want to sell, is whether your company is actually sellable. And the test here is not complicated. A good company is sellable. Company that isn't good is not sellable. So what makes a company good in a buyer's eyes? It comes down to a couple of things. One, whether they can look at your business and understand exactly what they are buying, and two, what's going to happen after they own it. That means clean financials, clean books, clean records, accounting that any outside accountant can verify in a week, not 3 months. It means that a team runs the business without you and they are already there. And there's a very simple test buyers use. If you went on vacation for 3 to 6 months, does the company still exist when you come back? Are the customers still calling? Are the trucks still moving? Is everything operational? If the answer is no, the buyer is going to lowball the company hard, or they're going to demand you stay on for years to transition it, which means a chunk of your value is now tied up in you not retiring and is on the back end. It also means a business that's growing, that is visibly growing, not shrinking. So buyers want to buy a future. This is very simple. If your story is in a declining industry, declining customers, declining margin, you're going to find it very, very hard to sell at the number that you want. And the very blunt version of this is that most business owners think their company is more sellable than it actually is. So if you're 12 to 24 months away from a sale transaction, the most valuable thing you can do today is look at your business through a buyer's eyes. Where is it dependent on you? Where are the financials messy? Where are the cracks you've been ignoring so far? Fix those now while you still own the company, because after the diligence starts, every weakness inside of your company becomes a negotiating chip for buyers to reduce the price you'll receive on the sale. Now, there's two specific traps quietly cutting millions of dollars off your sale price, and most owners don't even realize that they're standing on them. The first trap is owner concentration. If you, the owner of the business, are generating more than 50% of the revenue personally, doing the sales, holding the relationships with the largest customers, that is a massive issue. Anything above 25% starts to create a lot of risk inside of the company. Buyers are not buying you as part of the transaction. They cannot buy you because you're retiring, you're exiting. They are buying a business that has to keep running without you. And the more the revenue lives inside of your relationships, your contacts, the less they're going to be willing to pay for that. The second trap is customer concentration. The moment any one customer is more than 10% of your revenue, buyers start asking questions. By the time you've got one customer at 30, 40, 50% of your revenue, it's a major deal problem. They're either going to walk away from the deal or use that risk as leverage to pay you less in the transaction. Now, there's a more nuance to this. If you have a long-dated, underwritten government contract at 40% of your revenue, that can actually be positive for your company. But a handshake relationship at 40% is a massive disaster. Structure matters just as much as the percentage. If either of these cliffs describe you, the work you do in the next 12 months before you sell is you have to diversify off of them. Every percentage point you move yourself off the center of the business is a percentage of price you're going to protect and ultimately have for your exit. Now that you know why you're selling your company and you know if you're sellable, the next question is, who's actually going to help you sell your business? And this is where so many owners try to save money and it ends up costing them millions of dollars on their valuation. You wouldn't operate on yourself in a heart surgery. You would want a doctor. You wouldn't file your own corporate taxes. You would want an accountant. So you absolutely should not sell your own company. It is the single largest asset in your net worth, and you have probably never sold a business in your life. And this is the one transaction where the gap between knowing and not knowing is measured in 8-figure numbers. You need 2 highly qualified professionals. 1, a very good lawyer, and 2, a very good banker. The lawyer is going to protect your legal position in the documents, and the banker is going to run the entire sale process. They build the marketing materials, they target the right buyers, they create competition, they manage the timeline, and they ultimately negotiate the structure of the deal. And most importantly, they keep your emotions out of the room, which could distract you from actually getting a deal done. And one thing to know about Wall Street investment banks is they don't touch companies under $100 million. It's just not their market. So if you're in the $10 to $100 million range, you're looking at a middle market or boutique banker on that side. Their fee structure is going to run anywhere between $25,000 to $100,000 as an upfront retainer, and then a contingent percentage of the sale price. That percentage can range anywhere from 3 to 10% of the transaction, with smaller companies typically on the higher end of that percentage range. That fee structure may sound expensive until you realize that the alternative is a business broker who's not really respected by the actual buyers of your companies, or an owner trying to negotiate his own deal and ending up leaving millions of dollars on the table. So don't make that mistake. Now, once you've assembled the team, you don't just go to market just yet. There's another step that goes into it. The most important thing that happens or fails to happen in the entire sale process is proper preparation. Your banker is going to take everything about your business. He's going to find out everything and understand all the financials, the operations, the customers, the team, the growth story, and turn it into a marketing package. That core document is called a confidential information memorandum. It's effectively the package about your entire business. It's about 40 to 50 pages, sometimes more than that. It gives the buyer the entire picture in one place. Alongside that, you're going to build a data room that consists of every single document about your company sitting in an organized online platform ready for buyers to go through during diligence. You have to think about this like you're pitching your company. You're not waiting for buyers to discover how good your business is. You don't want them to ask the questions for them to learn how good your business is. You're telling them, here's an attractive investment opportunity, here's the growth potential, here's why this is unique, and here's why you want to acquire this before anybody else does. Therefore, pay the best price. Now, here's the part most owners get wrong. They're going to go and disclose everything except for the things that they're afraid of. So they won't put every lawsuit, they won't put every issue in the data room. And what happens is if you hide something in the beginning, you don't put it in the data room, and the buyer finds it in confirmatory diligence, they're going to use that as leverage to renegotiate the price down. They're going to say, you didn't disclose this. We thought we were buying a different business. Now we need to revisit terms. The best way to manage this is talk to your banker. They're going to help you navigate how to present this information to the buyer so that it does not scare them away in the beginning stages of your transaction. Now, quick one before we keep going. If you're already thinking, okay, this is the stuff I need to know before I sell, I have made a free PDF that goes even deeper. It's called the 7 Deal Killers, the 7 things I see most often blow up real transactions. The link's in the description, grab it, and now we're back to the video. This is maybe the most expensive lesson on the entire list so far. Most owners get one offer, they get excited, and they just take it. And they do not realize that the difference between a single bid and a real properly run process can be the difference between a small exit and a generational exit. I'm gonna give you a real example. A company called Remington Outdoor Company had a single bid offer on the table of about $60 million. We ran a proper banker-led competitive process for that company instead, and we ultimately sold that business for $160 million. That's a $100 million swing on one transaction, one deal. A competitive process means one of two things. You either have a real auction where your banker goes out to 50 to 100 different buyers, brings in multiple term sheets, and uses them against each other to get the best price and the best terms for your sale. The second option is you have a perceived auction where you go to a single best fit buyer exclusively, but you made it very clear from the onset you have 3 other buyers in your pocket as a backup. You have an entire process that they can fall back towards. Either way, the dynamic is exactly the same. The moment there is real or perceived perceived competition for your company, buyers are going to behave different and they start trying to win you and acquire your business. If you take a single inbound offer without a process, you are voluntarily giving up the most expensive piece of leverage you will ever have when you're going to sell your business. Now we get to the part of the deal that catches most owners off guard more than anything else. The headline price is not the deal takeaway price. Buyers are very good at making the headline number look great, while the actual cash you receive is much smaller at the end. There are 3 levers that do most of the damage here. The first is earnouts. This is where buyers say, we don't know if your company is really gonna perform the way you say it will, so let's both share the risk going forward. We're gonna pay you a base price, and then if the company hits certain numbers over the next 2 or 3 years, you get to participate in the upside of that. Sounds good, but here's the problem with that. The day you sell the company, you no longer own it. You don't control it, the buyer does. And the buyer is the one running the business. They're gonna determine whether your earnout actually gets paid. For example, an earnout tied to EBITDA is particularly dangerous because EBITDA can be moved in 100 different ways and adjusted in the way the new controller wants to make it happen. Secondly, you have deferred comp and equity rollover. They tell you we're gonna pay you $100 million for your company, 70 of it is at close in cash, with 30 in equity in the new company. That sounds fine until you realize you now hold a minority illiquid position in a private equity owned business you don't control, and you don't know when or if they'll ever sell it. Thirdly, there's escrow. This is where they pay you 90, hold 10 in escrow, and over the next 12, 18, or 24 months, they audit everything you told them about the business in due diligence, and if anything is even slightly off the picture you painted, they take $10 million back. Now, this is how a $100 million headline number can become a $50 million actual payout. And the biggest one that catches people off guard, by the way, it's not the cash versus equity split. Most business owners understand that one. It's the escrow, the working capital reserve, because those are all technical and they show up towards the end of the documentation. They don't show up on the term sheet, they don't show up in the LOI, they look like standard paperwork, but you don't understand how much value you're trapping inside of the structure of that deal. Here's a line every owner needs to hear, and almost none of them want to, unfortunately. You do not know what your company is worth, not until you go to the market and actually test it. Most business owners walk in with a number inside of their head. They built this business for 20 years, 30 years. They think it's worth 50, 100, $200 million, and that number is really not tested against anything real. The only thing that actually drives valuation is what comparable companies in your space have recently sold for and what a buyer in today's market is willing to pay for your cash flow today. Your banker is gonna take these comps and they're gonna analyze it once they have all the information about your business, once they're working with you. And the 2 main lenses are really enterprise value compared to revenue and enterprise value compared to EBITDA, with EBITDA being the primary dominant one in most industries. A few rough ranges because owners always want a number. Smaller companies, say 10 to $15 million, tend to trade at 4 to 6 times EBITDA. Larger companies in the higher tens or hundreds of millions of dollars will trade more like 7 to 10 times. Industry also matters just as much as size. A small AI software company can get double or triple the price of an industrial business 10 times its size. So lots of nuance that goes into that valuation piece. And one more thing about going to the market, even if you do not sell, the feedback is worth the process and the retainer. The market's gonna tell you exactly where your business is strong, where it's weak, what's holding it back, and what you should change in order to add millions of dollars the next time you sell and come into a process on that side. Now, there's a quiet killer in every sales process, and that is the business itself dipping while you're trying to sell it. Most owners assume the company will keep running fine during the sale transaction while they're focused on getting the deal done, but that usually doesn't happen unless you're focused. A sale is a full-time job on top of the full-time job you already have, so you're gonna be answering hundreds of diligence questions, you're in management meetings, in negotiating calls, and you're drafting documentation, all the while your team still needs to operate. You have to stay on top of them. Sales cannot dip, your fulfillment cannot fall short. Buyers are gonna track your numbers monthly in real time during the process. So any decline month over month, quarter over quarter is a red flag, even a small one. They're not looking for big drops. They're just looking for trends. 2 months of softening revenue, even if it's within a normal range, is gonna be something they're gonna use to renegotiate and have leverage over you in the sale. So before you start a process, decide who's holding the operating wheel while you sit in the deal seat. If it's still you doing both the deal and the operations, you're carrying the most expensive risks in the entire transaction yourself, which is why having a banker run the process for you is so invaluable. They take all of that process and time off of your shoulders. There's a phrase you'll hear from any banker who's done this for long enough: time kills all deals. The longer a deal drags on, the more likely it is to die. New problems get found, market conditions change, buyer fatigue sets in, seller fatigue sets in. The original LOI starts to feel stale and no longer relevant, and the price starts to drift, usually downwards. And almost every deal that falls apart did so because the timeline was controlled by the buyer instead of the seller. A controlled sale, run properly, has a clear shape and definition. It's roughly 3 months of preparation up front. Then you have roughly 3 months in market where your banker is in conversations, taking meetings, soliciting interest, and getting to a letter of intent from buyers. buyers. Then you have another 2 or 3 months from the LOI where you have confirmatory due diligence to close the deal. All in all, 3 to 9 months for a clean deal, 15 months at max, depending on the size of the business. And the way you control that timeline, the way you stop the buyer from dragging it out, is your banker is going to set very hard deadlines and enforce them. So indications of interest will be due by this date, letters of intent will be due by this date, management meetings will be held on these dates, final responses will be due by this date, and if you can't meet the timeline, you get dropped from the process. And that's how you maintain your leverage as a seller so buyers don't take advantage of the timeline. If you let the buyer set the clock, you've lost. They'll slow play you into fatigue and then renegotiate from their position of strength. So either move fast or don't move at all.